So the market snapped its 7-day losing streak as the RBI policy decision was on expected lines. The Friday bounce, though, was led by financials. However, the markets lost steam for the third straight week. Today, we put the spotlight on why Indian banks are ahead of the pack and why pharma stocks have been outperforming. Hello and welcome to the Editors Roundtable. I'm Sonia, and today with me I have the editors Nimesh, Anuj as well as Nigel. Folks, it was an interesting week, but guess what? Next week there are many things to watch out for. I'm watching the midweek holiday very closely. I think that is something to look forward to, right?
Oh yes, absolutely. Midweek, end of week, Monday, any day is fine, Sonia.
But it's a truncated week next week.
Absolutely, the Shara is there. So, but you know, just a word on the market. We all have the biases, right? So today it all looks so great, and the Bank Nifty was up 3%. After all of this, the Bank Nifty for the week was still down 2.3%, and the Nifty was still down. But you know, my sense is, and I made this point in the morning as well, that perhaps from the risk-reward point of view, the market was bombed out, and it could really give you a nice opportunity if the shorts get stuck. We are at a record level of shorts in Indian market, $1.5 billion of short positions. I have not seen this kind of shorting at the start of the series. I think the ingredients were in place for short covering. But Monday morning, we'll again watch for dollar index, the dollar rupee, and see if that rally sustains or not.
Oh, absolutely. And I think there are not too many events left, right, in terms of rate hikes as well.
After a few weeks now, Sonia, I'm actually betting for the bulls. You know, if you remember, for the last 3-4 weeks, I've been saying that markets were giving signs of some bit of exuberance. You know, everybody was making money. It was becoming so easy. It was becoming so obvious. Now I think there is fear in the street, and that's where, you know, when for large investors, they normally buy in this fear, and only when you buy in fear markets, you make big money. So there is a lot of fear in the market. I'll talk about that in terms of index levels as well. But I think that's what the sentiment seems to be. You know, at 18,000, everybody was exuberant. They were looking at 19,000 levels, 19,500 levels by Diwali, and at 16,800, there is a lot of fear in the market now. So that's where I believe, you know, buying the fear will be a great thing to do for investors, and that's what large investors seems to be doing now, because that's what my interaction seems to be when I spoke to a couple of large guys.
And from the Indian market perspective, you know, I just want to compare two events. It's like we're running the marathon. Everyone believes that Indian markets, we're going to complete that marathon. We're going to be healthy out there. And in the near term, it appears like 100-meter hurdles. So everyone's going to be, you know, having those hurdles. But it appears at the end of it, maybe we could complete the 100 meters faster than most others. The outperformance of India could continue. At least that's the sense that you got. And the point that Anuj made, the net short position. The last time we had such short positions at the start of the series was in July. Nothing to say that it's going to happen again, but the markets rallied big time in July itself. So let's see how it plays out this time, but at least it's a good start to the series.
Okay, good start to the series. Anuj, last week your focus was on the IT stocks. Today you've moved your focus to banks. Why is that?
Oh yes, because you know, Indian banks have been outperforming. Let me just go to the big wall and explain what the kind of outperformance that we've seen for the Indian banks ahead of the pack. And you know, in some way, you know, it's my lucky day that the Bank Nifty did what it did today. So, you know, it's topical as well. Now, this is what the developed market financials have done. And this is a study by CLSA tracking Bloomberg data. Over a 1-year period, the developed market financials are down 21%. And from pre-COVID levels, they're actually down. They're down 6%. And look at emerging market financials. From over a 1-year period, they're down 14%. And from pre-COVID level, down about 8%. The Bank Nifty over a 1-year period is flat. But from the pre-COVID levels, it's up about 24%. I think it's the next plate which would exemplify what I'm trying to explain. Just look at some of these stocks. Now, I've taken the big ones. HDFC Bank, which has been the problem point, is down 11% over a 1-year period, but from pre-COVID up 16%. But look at the two big ones, the two go-to stocks. They keep coming back, of course, in my chatter as well. ICICI Bank and State Bank of India. Look at 1-year move, 19%, 23%. And look at the move from pre-COVID levels, 64% and 71%. Look at US banks. They have collapsed. JP Morgan and Citibank are down about 35 to 40%. The only other bank which comes close to Indian banks is DBS, which is up 13% over a 1-year period, and from the pre-COVID level, it's up about 31%. Now, what is the biggest reason for this, according to CLSA? And this is where, the corporate slippages comes into picture. At the peak of FY18 corporate slippages, Axis Bank was at 15.8%. It's come down to 0.9. ICICI from 9% to 0.7%, and SBI from 7.3% to 0.2%. This was the reason these three stocks were underperforming back in FY18, and this is the reason these stocks have now started to outperform. Not just that, the corporate India has been deleveraging. Again, this is CLSA data. Look at corporate credit. Of course, the overall credit has gone up because the economy is getting bigger, but as a percentage of corporate credit and as a percentage of, total credit and as a percentage of GDP, they've come down from 78% to 69% and from 69% to 55%. So clearly, that's a big positive for the banks. What is the provision coverage ratio? It's very high for the sector. This is average of PCR of ICICI, Axis, and SBI. I take these three stocks because these three really, count for the for bulk of the corporate credit. In that, look at where the number was in FY18, 48.4%, and look at how it's moved up to 76%. Basically, the point here is that banks are healthy, and that's why this rally. The banks were not healthy in FY18, and all through the painful period, these banks have now become healthy. The next graphic, I think, is astonishing. Just look at how the credit cost has moved for the three outperformers versus the other three. Let's move to the next graphic. ICICI Bank, Axis, and SBI. The credit cost, that next graphic would come up for you now. And there it's come off quite a bit. From 3.69%, it's come down to 0.8% for ICICI, Axis, and SBI, while for Kotak, HDFC Bank, it's been pretty stable. Now look at the capital levels for most of them, the CET levels. They're comfortable. Most of them are sitting comfortable, except for Axis Bank, which might need to raise some capital after the Citibank deal. But this is where as well, the issue here is that they don't need to go for large capital raise, and that's why that number really stands out. Now let's look at the sector valuations, current valuations versus average valuations. I think that is the most important point. The banking sector is trading at 9% discount compared to its 10-year average. 10-year average is something that you look at. That's something to watch out for, and that's why I think these banks have been doing rather well. But Nimesh, what did you pick up from the dealing rooms?
So, you rightly pointed out about the valuations, the reason for banks to do well. And the fact is, we're starting this series with the fact that the Bank Nifty last year was down 10%. This was the most overweight sector, most loved sector for most of the investors, and that's why we saw a big fall, because there was so much of over-positioning. That seems to be out now. A lot of the fraud or the retail, so-called retail participation in the banks seems to be out after the 10% fall, and many stocks have now reached very crucial support levels. So that's something one needs to watch out as far as the banks are concerned. Overall, from a market point of view, as I said, one needs to just buy the fear now, because there is so much of fear in the market. This week when I was talking to some large investors, traders, there was so much of scare now that people are talking about 14,000 levels, 15,000 levels in the Nifty. That was not the case 3 weeks back when we were closing 18,000. People are talking about 19,000, 19,500 by Diwali or by December. So there has been a big shift in sentiment in the last 1 week, 10 days itself. With the kind of fall we've seen in the Indian market. So sentiment is clearly on the other side now, which is where I believe market may surprise on the upside. And even from a technical point of view, there are a lot of indicators suggesting that maybe we'll have a sharp technical pullback rally, not only for the Indian markets, for the global markets as well. That's where, as Nigel pointed out, the net Nifty short positions of FIs is the highest, and we saw what happened when it was last in July, and we saw a big rally. So a lot of technical indicators are suggesting a big pullback for global markets as for the Indian market. So that's something to watch out. Historically, if you look at the October series, for India, it's been a good series. Normally we end on the positive side. The last 3 years have historically been the trend that, October seems to be a positive series for Indian markets. So that again seems to be suggesting that there could be a bit of a pullback rally. The most important thing is, while everybody's talking about risk, and now it's more prominent because markets have fallen and we are catching up with the global underperformance, my sense is the key risk is the unknown. What I mean is the known factors like rate hikes, inflation, the US growth data, all seems to be known factors now. Normally, markets don't react very heavily on the known risk. Only if there is an unknown risk, markets can fall very sharply from here on. So that is something. Maybe it will come from China, maybe it can come from Europe. The way things are shaping up in Europe, it can give a big nasty surprise going forward, which is not priced in. Otherwise, the rate hikes, the growth, that seems to be priced in. It's a known risk. So watch out for unknown risk for the markets to fall sharply from here on. That's the overall message I'm getting in. I just want to toss it to an interesting bite or a quote plate from Alexander Redman of CLSA. he's put out a note today morning. He's saying that the US tactical indicators are now flashing green for the near-term equity bounce. The last when they saw these kind of bearish levels in the S&P, and from there in 2 consecutive months, the S&P has rallied 17%. That's the kind of powerful, you can see a pullback rally or a short-term bounce back rallies, not only in the global markets, but for the Indian markets as well. So do keep into account that we could see a tactical pullback, and the fact that there is so much of fear now, looks like market can surprise on the upside, because nobody is anticipating a big rally from here on. So these are a few things to watch out for.
All right, guys, I'm looking at the Pharma index, and the Pharma stocks, the question is that the place to hide? And I'll tell you why. Because for the past week, everyone's talking about the Nifty being under pressure. Everyone's talking about, how the markets were in a bit of a pain point. But the Pharma index for the past week, it was up close to around 3%, while the Nifty was down 1%. And for this month itself as well, it's been a relative outperformer. So that's why that index is on my radar. In fact, it's been a big underperformer though. If you're looking at it from 2015 till date, the Nifty has close to have doubled. The Pharma index has done absolutely nothing. Now the Pharma stocks, as a percentage, the weightage on the Nifty, well, it was close to around 7 to around 8% in 2015, from where things started going wrong. As for the last month, it's down to close to around half of that, close to around 3.6% or thereabouts. The domestic mutual fund as well, the aggregate data that comes in there, the exposure has come down to the lowest we have seen in the last 30 months or so. So that's telling you that the domestic mutual funds as well, the exposure is reasonably lower. Now, what went wrong from 2015 itself? You had price erosion, you had buyer consolidation in the US markets as well, and regulatory overhangs from the US FDA as well as in the domestic markets as well. But why could Pharma be a potential good bet from here on? Potential with a question mark. Let's pull up the point number 1 first. The big fear for the street is discretionary spends getting pulled back. Well, Pharma is not discretionary in nature, right? It's more or less inelastic demand that drives it. So that's point number 1. The other big fear is the rupee depreciation. Well, that could be good for them, for some of these large generic companies, because 30 to 40% of their money comes in the dollar. So they'll in fact gain. It's on the margin positive, and margins could expand for the second half of the year. API prices have cooled down. Supply chain issues as well have been getting ironed out. So second half of the year, the street is building in some bit of gross margin expansion. Point number 4 is US price erosion. Last few years, there's been a big erosion out there. Now the street believes that maybe we're getting to a bottoming out of that. And on the domestic front, the essential medicines, well, they have got a price revision. So that's what could support some part of their portfolio as well. Put these 5 points together, maybe there could be a bullish argument for Pharma that could be built out from here on. In terms of stocks and their valuations, well, I'll leave you with this plate. Cipla as well as Sun Pharma, they're trading at valuations close to around the 52-week highs, because obviously the stocks are at 52-week highs. But quite a few of these stocks, well, their valuation has come off considerably as of now in comparison to what they were trading at their 52-week highs. But Sonia, coming back to you, what are you tracking? What are the events to watch in the coming week?
Okay, so this week is done, right? But there are many events to watch in the week to come that we're looking at. Auto sales, the market will react to those numbers, and this time the festive demand has been good. So across the board, whether it's passenger vehicles, commercial vehicles, the demand has been solid. In fact, for most passenger vehicles like Maruti and M&M, there'll be an over 100% growth on a year-on-year basis. Apart from that, you have names like Ashok Leyland, Tata Motors. Infrastructure activity is back, truck demand is back, and that will show through in the numbers as well. The only sore pocket will be two-wheelers because of the exports which have been sulking. But let's move on to the other big trigger, which is the telecom stocks. Definitely will react to Prime Minister Modi launching 5G services in India on the 1st of October. The two big questions that we're asking: will 5G trigger another leg of consolidation in the Indian telecom sector? And will 5G launch drive another increase in the average revenue per user? We already saw a big boost to names like Bharti in the week gone by. The third thing I'm watching out for is the gas price hike. From the 1st of October, there's a 100% hike in APM gas prices that's expected. Remember, currently the gas prices are at $6.1 per MMBTU. But there's a caveat here. The government had appointed a new panel to review gas prices last month, and the government panel was given time till the end of September to finalize this report. Now, sources have told CNBC-TV18 that they have not been able to do justice to the issue of gas prices just yet. So it could be a status quo as far as the gas price hike is concerned. So these are the three big events to watch out for that the street will react to next week. But the biggest one for me definitely is the midweek holiday still. Let's do one thing. Let's take a quick commercial break. But on the other side of the break, we will discuss the market fundamentals. I have with me Rahul Arora, of Nirmal Bang Institutional Equities, who will be with us on the Editors Roundtable in just about 4-5 minutes from now. Stay tuned.
Welcome back. You're watching Editors Roundtable. We have a guest joining us now. Rahul Arora is with us. Rahul, good to have you in our studios. First question, what did you make of this big bank nifty rally today after the policy?
So thanks for having me, Anuj. I think it was a market neutral policy. I think the good part was that he was not as hawkish as people were expecting. And I think if you look at the 10-year yield spread between the US and India, it's down to about 3.5%. Historical averages are about 5%. So I don't think there's too much by way of a bond market rally on the 10-year expected as well. So I think from a mark-to-market perspective as well, I think banks are in a better place. I think from now on, I think you probably see deposit rates inch up a little bit. I think all in all, obviously, Anuj, the other important factor is that you've seen a shift away from IT. So from a large cap to a large cap, I think there's been, and today was the last day of the quarter where you would have seen some NAV adjustments as well. So you would have had some portfolio flows flowing just because of a technical adjustment into the banks. But I think overall, it was a market neutral policy, and the fact that I don't think the fixed income traders or the bond market experts are expecting too much of a rally in the bond yields from here. From a mark-to-market perspective, I think it's all right. So valuations are still very comfortable, Anuj. I think it's been a sector that's over a period of time underperformed. Obviously, off late, the ICICI and the SBIs have been doing well, but if on an aggregate basis, there's been a sense of under ownership and underperformance. So kudos to it, and I hope it sustains.
And a lot of right things have happened, right? I mean, credit growth is picking up, asset quality is stabilizing. But, Nimesh was making this point earlier about how now there's some fear in the market, and it's the best time to buy when the market is fearful, perhaps. How are you reading into it? Do you think one should just perhaps take a step back, keep your powder dry, or is this the time to go all in?
So there are two ways to look at it, Sonia. There's an optimistic way and there's a pessimistic way. Optimistic is if you see the last 2 years of COVID, corporate India's balance sheets are as healthy as they've ever been. Debts are at the lowest level, cash flows are at the highest. Capacity utilization is at 73%, and corporates are investing left, right, and center. So if you have a situation where capacity utilization inches up to 80%, you're probably getting into a situation where profit growth is going to be extremely handsome. So if you look at the market from that perspective, you'll buy every dip. The concurrent side to it is that the US has gone just completely out of whack with interest rates, and you don't know how severe the recession is going to be or the slowdown is going to be next year. And the IT stocks and the IT index is giving us an indication to that effect. If indeed it pans out such, I think the pain could be slightly more protracted. So you may have a situation where earnings growth may still come through, but you may not be backed by the kind of liquidity to buy the stocks that you've had over the last 2 years. So you may still end up being in a net neutral year where the Nifty probably moves in a 15, 16 to 18, 19 kind of range, but doesn't break out in a material way on either side. So I think just before we went on, we were discussing 4-5 months back, the Nifty did fall from 18 to 15. And the ferocity with which it bounced back, I think because this entire sort of notion of liquidity is so large, and everyone who's missed out will probably want to buy every fall, which is why you're finding that even though you're having these dips, they're not sustaining for even a period of 15 days. So, by all means, if you've missed out, go in and buy. I think from a corporate India standpoint, I'm optimistic. Just from a liquidity standpoint, I'm a bit worried. But if you're getting the quality stocks at your price, why not?
But Rahul, what about on the Nifty itself? The mother market has broken that June lows that we saw. We are still a good 10% away from here. You think that level will hold up? The June lows, 15,100 odd?
There is no incremental evidence, Nigel, to suggest that it shouldn't, right? Because the last time we were there, crude was at 125, 130. Yeah. Today you're at about 85, and the CAD number that came in overnight, if you looked at our estimates and the market estimates, they were between 3.2 to 3.5%. So optically, a 2.8% looks bad, but it's still far better than what the street was expecting. My sense is that after hearing the RBI governor today, I think they'll balance the rupee where it is. So I think from an economic standpoint, I don't think things are too bad. In fact, we're sitting far better today than we were 4-5 months back. The only thing, like I was saying to Sonia as well, is how does liquidity pan out from here, from the central bank angle and from the FPI angle? That is the big variable that none of us can predict. But like I said, because you've had such a sharp run from 7,500 to 18.5, every dip, that fear of losing out could potentially cap the downside. So it's a very good chance that level holds out.
Rahul, you talked to a lot of your clients as well, both FIs and DIs. What are they doing? For the first time in this calendar year, India is trying to do a catch-up with the global underperformance. We've been a rank outperformer for the last many quarters now. Now, after a 10% fall in Bank Nifty, a 6% fall in the Nifty, what are clients telling you? Are they willing to put in money, or they are like, just hold on, sit back, just look at what happens in the global market?
So, Nimesh, I think when I talk to mutual funds, I think the average cash level is between 3 to 5%. If I talk to insurance companies in India, average cash levels would be between 8 to 10%. Now, I think the one material thing that has changed over the last 5 years is demonetization. Because the size of the mutual fund industry back in 2016 used to be 5 lakh crores. Correct. Today, it's 8x that at 40 lakh crores. And equity within that would be about 18, 20 lakh crores. So, the buffer you have from the DIIs itself to push the market up is at record high levels.
That's what is helping Indian markets.
Absolutely. Right? So, to that extent, you know, there is a bit of a decoupling that you've seen from a liquidity standpoint, because Indian capital markets have never had this level of domestic liquidity to counterbalance the FIIs. I think if you spoke to somebody 4-5 months back and said you'd see the kind of FII buying that you saw in the last 45-50 days, I don't think we were anticipating that. So to that extent, I think it's good that both are, sort of moving in tandem. But my sense is that as you get closer to the end of the calendar year, when the FIIs rebalance for the year, we do that typically in March, you may see a little bit of FII withdrawal. But I think we should be in a position domestically to absorb that. I mean, deals are going through, you yourself are reporting them with such ease at every level. Blocks are getting, subscribed, and issues are getting subscribed. So it's still telling you there's a reasonable appetite out there. So I think there is a very healthy cushion, the likes of which we've not seen, say, in Lehman or 2013 taper tantrum or other instances in the past. This time, the counterbalancing force is just too strong.
Okay, well, forget about all that. It's the weekend, guys. So what are you all planning to do? I mean, there's so much to do this weekend.
We've planned for this weekend.
You don't want to share? I mean, there are some new movies releasing. Vikram Vedha is releasing as well. I mean, that looks pretty interesting.
I don't think I will go for the movie.
I want to reveal, but Sonia, Rahul is dating us, so we called him here only for that, so that we can go with us.
Only for that.
Thanks for leaving us out, by the way.
But I think the multiplex industry might be in for some good times. Yeah. I think there is, you mentioned Vikram Vedha. There is Ayushmann Khurrana's movie Dr. G coming out, and there's
a South Indian movie which apparently is very good.
That one too. I think that's the Aishwarya one, if I'm not mistaken. Yes. And then you have one with Ranveer Singh and Alia Bhatt. So I think the October to December.
Love for QSR, for exhibition businesses and all. So
I think it should be.
Many other big names will latch on to Aishwarya Rai.
Sorry. Well, Alia Bhatt. I did mention there's a Ranveer Singh and Alia Bhatt movie coming through as well.
Almost all equity market observers or commentators, right, are big Bollywood fans. That's one thing I've realized. So
content fans, that's it.
Content fans, okay. Well, with that, it's a wrap on this edition of Editors Roundtable. Thanks so much for watching. We'll be back again bright and early on Monday.